In this video, I'm going to show you how you can consistently create passive income, retire early, and make $5,000, $10,000, even $20,000 a month or more. And the best part about this strategy is it works on smaller accounts as well. Don't worry about subscribing, tapping the like button, or looking for the coaching and Discord link just yet. Let's jump right in to this video so I can show you guys exactly what to do in order to create passive income for yourself. The biggest factor in consistently generating income and retiring early is sentiment and psychology and understanding of the market. But once you have that down, which I discuss in my coaching and my training course, and I make videos on all the time, once you get past that, you have to choose good stocks, value these companies, understand the direction that they're likely to move in. This way you can position yourself to set up options and trades in order to generate consistent passive income. However, it's really hard to do this on most stocks because even when you sell puts on a good stock, sometimes it goes down, you get assigned. But when you pick good companies, it happens less often. However, if you want a higher percentage win rate and more wins, less losses, it's much better to go with an ETF over a stock, more specifically the SPY, because the S&P 500 is an ETF that's rebalanced every quarter. It is unlikely that this stock is going to trend continually in a down direction or consolidate. Sure, there's going to be pullbacks and there's going to be weeks or maybe a month or two where it consolidates and moves back upwards again. But anytime you look at the S&P 500, there's really only been 2 or 3 times in 20 years that this ETF has consolidated or dropped for more than 30 or 60 days. And this is the pandemic, the housing crash of '08, and then September 11th. There's been some few other instances where it's pulled back or consolidated for a very brief time, but anytime during this 24-year window, besides the 3 times I've mentioned, the S&P 500 has continually went up, had a pullback, went up, had a pullback, consolidated, and went up. And some of the pullbacks are rougher than others, but anytime you go over the course of any 6-month to 1-year window, the trend is still up, which means if you are trading the SPY, you are still generating good, consistent income as it's more reliable. Let me show you 2 very powerful strategies that you can use and implement into your portfolio. One of the best and safest, consistent ways to make profits in the market is to sell puts. However, to sell puts on the SPY, Tesla, Meta, Google, Netflix, any of these big stocks, you would need at least $250,000 because they're all going to be between $20,000 and $50,000 a contract, and you would need to have 2, 3, even 4 contracts a week to make decent money. So you'd need $250,000 plus. You don't want to put all your money into one position. So realistically, you'd need $500,000 or more. And this is kind of expensive. It really is. I mean, my portfolio is over $2 million and I can barely do these kinds of puts on Netflix, Meta, Google. I mean, if I sell 5 puts on Meta and 5 puts on Netflix, this is over $600,000 or just about $600,000, which is 20% of my portfolio. So you really need a massive portfolio to do all puts consistent income. However, in this video, I'm going to show you 2 strategies where you can make good passive and consistent income and retire on as little as $50,000. However, if you have $100,000 or a $200,000 account, you can really start making a lot of money. At $100,000 to $200,000, you can retire early. You don't need to work anymore. Although I'm not saying quit your job or anything, but you can pretty much retire on $100,000 conservatively, and on $200,000, you can retire and do very well for yourself. Let's dive in. Let me show you these exact strategies and how to implement them into your portfolio right now. However, before we do that, if you're having trouble in the market, you want to retire early, maybe you're just having difficulty understanding these strategies, you don't know where to begin. I was there too at one point, fam, and my students were as well. So let's take a listen to what my student Adam had to say after he turned his $15,000 account into over $40,000 in just 2 months.
In just a short amount of time, the program that you offer, I've learned so much, and I've changed my entire approach to investing. You know, I'm much more structured, much more safe, and I've seen consistent, profitable growth. I've seen the growth, and it's almost like unbelievable. Like in a market that we're in now, I was still able to consistently grow because you're so, methodical and structured, and you care about each student. I'm here to say it how it is, right? I've made consistent growth. So I started with 15,000, right? I am now at $40,000. Okay. And I'm so proud. It feels, amazing to be able to share this, because I know that there's so many people that will do the same, right? You have to just trust Corey and trust what he's teaching and what he's offering, because he means so well.
Many people ask me, Corey, why do you put so much effort into this? Why are you teaching and coaching so many people? Why do you care so much? And really, the honest truth is I hit rock bottom just 6 years ago, had a divorce, and I told myself that if I was able to build myself up and build a system that worked for me, I would make it work for others. And the fact that I grew up in a Catholic household, and my whole life, my parents have pretty much instilled values into me to help others. I help homeless veterans. My family and I work closely with homeless veterans, and I find this just another great way that I can help others, and I thoroughly enjoy doing that. That's what drives me every single day. So if you guys want to sign up for the coaching, you heard what Adam had to say, you've seen the profits on the screen, you're getting to know me by watching these videos. You guys can sign up at any time at investwithcorey.com. The link is in the information box below, and I look forward to helping you on your financial journey whenever you're ready. Okay, fam, we're sitting here looking at the SPY. Remember, Apple controls a majority of the tech sector in the SPY. In fact, it's the biggest holding in the S&P, but it also holds Amazon, Google, Meta, all the big stocks, AMD, Nvidia. And when we have AMD earnings that didn't do too well, Apple earnings didn't do too well either, but Amazon's did. It still doesn't make up for AMD and Apple being the largest. So the S&P pulled back, not to mention the tech sector completely pulled back, and that's what caused the S&P to pull down. And because of elections and the uncertainty, S&P is probably going to come back a little bit more. I anticipate a true bottom to the S&P at 550, maybe 555, but 550 I see as the bottom down here. I see this as being a really strong support, although I don't think it'll break 560 to 564. So I think 560 to 564 is pretty safe. And I think 568 to 570 could still hold, but I would still think that we could have a drop to 560 or 565 between now and the beginning of the elections. And then everything should start running after that. So what I would look to do is I would look to get into the S&P in order to start generating consistent passive income. This is how you generate $5 to $10 or even $20,000 a month. Let me show you exactly how we're going to run this strategy. We're going to go to the SPY. So you guys will see that I have 3 calls going out to April 17th. They're 560 strike. My average cost is 43, although right now they're about 38 to 39, depending on where the SPY opens. So I'm out roughly $1,200. But if we see some stability here on the SPY at 565, 568 going into election time and it starts to go up, I'll buy another one for $3,800, $3,900, and it'll put me like kind of in a break even of around 4,200, maybe 4,150 dollar cost averaging. As you guys can see, I paid 45 for one, 44 and change for the other, and then 43 and change for the third one, giving me an average cost of 4302. Actually, I think that may be a little bit different. 45, 4485, and 3920. So give me an average cost of 4302. If I can get in around 38 or 39, it'll give me an average cost of just under 42. And then my dollar cost average will be pretty good. The SPY is at 570.30. It's actually went up just a little bit. This contract is actually worth $100 more. So I'm $300 more in the positive, which is good. But what we're going to do is we are going to go in and we're going to buy a leap option. If you were going to be purchasing the SPY, you would need $50,000, $57,000 to be exact. If you're selling a put, you would need the same thing. So if you have a $100,000 account, you could put $50,000 into SPY, maybe $40,000, and then put the remaining $50,000 or $60,000 into different stocks, spread it out into 3 or 4 different stocks. But for the purpose of this video, we're just going to utilize the full $100,000 on the SPY, although I don't recommend that. So I'm just going to tell you to do your own due diligence. And if you have a $100,000 account, it is kind of safe to do 20 or 30K in SPY. 20 or 30% is not bad because it's an ETF, and then run the remaining amount in different stocks. But since we're going off of Delta, and we're using and selling short calls of a 20 to 25 delta, sometimes 30. We're just going to do this all on the ETF, the S&P 500 or SPY, just so that we can get an idea of what 100,000 in total investing or 50,000 in total investing can return for us. So let's start out with $30,000 or $50,000 and show you exactly what you can generate on the SPY. We're going to look to go out to April 17th, look to buy a call, and we want to go deep in the money to some degree. I have 560s because I feel even a big pullback for the election is going to be between 550 and 560. I'll be right at the money, so I don't really need to go any deeper. But if you want to play a little bit safer and go to a 550, this is a delta of 68. 540 is a delta of 72. So let's just say we're going to play this a little bit cheaper and go with 560. A lot of people don't explain this very well on YouTube or in their teaching or coaching. If you buy a 560 leap option, and the stock price goes below 560, let's say it goes to 550, you can still sell covered calls, but you're responsible for the spread. For example, if the SPY goes to 550 and your leap option is for 560, you can still sell a 565 call, but you're responsible for the difference between 550 of the stock price and 560 of your leap option, which means in order to sell the 565 call, you'll have to put up $1,000 cash collateral. That gets released after you buy back or the option expires, the short option that is for 565 in this example. So just know that if it ends up going to 550, you can still use it as collateral, but you'll have to put up the $1,000 difference or whatever it may be. If the SPY drops to 540, it'll be 2,000 collateral per call option. So this is how you have to do things with a leap option. If you're running this in Robinhood, they will close your short calls out. They will close them out. They'll get closed out at 3:30. Unfortunately, Robinhood does not support in any way, shape, or form short stock positions. And since this is a leap option, you are selling covered calls against it. But as you get closer to the end of the day at 3:30, it has to be closed out or rolled because they don't accept you to be in a position or allow you to be in a position where you're shorting the stock, because that's really what you're doing. Some brokerages will. Just be aware of this. If you're trading 0 DTE, Robinhood is going to close it out, or you're going to have to close it out every day, and you'll be a pattern day trader. So if you have over $25,000 in your account, you don't have to worry about this. But if you have under $25,000, I don't recommend it. I recommend trading every other day. Sell for tomorrow. When tomorrow comes, buy it back or roll it. You'll be good to go. But if you're going to trade 0 DTE, you must have $25,000 in your account. So we're going to buy this option. You're probably going to get filled somewhere in between, which is going to be right around $3,800. So what we're going to do is we're going to buy 10 of these options contracts, which is going to be $38,000. And what's going to happen is we're going to buy these and then we're going to be able to sell covered calls against them. Now, remember, I do have an open contract on the S&P 500. So if the S&P was to go to 590, then we would be making about $2,700 in 3 contracts. So this would be about a $10,000 return on 10 contracts, because you can see it'd be worth about $5,200 per contract. But if we go out closer to February, we're going to be rolling these options out to probably March 1st. We'll still be at break even to the current price. So if we hold out to March, which is about a month before expiration, and we're just selling and the stock price is going up, we're selling short calls, it's going to be pretty close to a break even. Remember, my average cost is 43. Yours is probably going to be closer to 38 if you get in now, maybe 39, which means your break even will be a lot lower and you'll be able to get out pretty much at a break even. But it depends on when you get out, and this is just a simulator, it's not 100%. So realistically, if you hold to about 30 days prior to expiration, if the stock goes up a decent amount, you'll be pretty close to break even, and pretty much all the short calls is where your profit will be. However, if SPY was to go to $600, so at $600, we can go out to March 1st and we're still at a profit. So you figure we can sell these or roll them, but we'd be able to sell them for about, right now, about $800 a contract. So you stand to make about $8,000 if the SPY goes to 600, okay? Which is not a lot. It's only about $15 than the previous high a couple weeks ago. We have like 5 months for this to happen. We're after elections. It's highly likely, honestly. But we'll just look at this. 10 contracts times $800, 8,000. Now let's go ahead and look at our covered calls. We are going to sell covered calls against this, and we're going to sell 0 DTE. So if we were to sell, and right now we're going to want to sell a 20 delta, if we look, the SPY breaking beyond 578 or 577 is highly unlikely today. And we can do this and do our due diligence by using Bollinger Bands and looking at the delta. And we're going to see that 577 is $82 a day, delta of 17. Realistically, I would say you can expect about $50 a contract to play it on the safe side, which will go up here. And you'll get about $50 a day, maybe 60, but this is in the overnight hours. So this will update in the morning. This is only going to be worth about 50, maybe 48. So we'll say 50, 10 contracts. You'll collect $500 a day. We'll do this 5 days a week. 5 times 500 is 2,500 times 4. We're looking about $10,000 a month. And if we want to play this a little bit safer, we can go out to 11 delta, which is going to give us about $40 a day. But that's still going to be $2,000 a week or $8,000 a month. So even if we play it very safe, it's $8,000. If we play it fairly safe, it's $10,000. So the very safe option is honestly very unlikely that you're going to get assigned or have any issues, but you can always roll out a day or two or a week, but that eats into profits. So let's go with the very, very safe $8,000 a month. And we're going to run this for November, December, January, and February. 4 months times 4, $32,000. Let's say we break even. Or let's say the S&P is stuck at 580 or 585. It doesn't really go up. And we're at a $300 loss per contract. We lose about $3,000 on the contracts because they're worth, because of decay, a little bit less than we paid. Even in worst case scenario, the contracts are worth less. S&P does not really go beyond 580 by March, which is highly unlikely that won't happen. And we're super safe on the covered calls. By the time it's all said and done, we still make $29,000 divided by 4 months. We're still making $7,200 a month on $38,000. Which is a lot. This is a lot. 10% of $38,000 is $3,800. So 3,800 times 2 is $7,600. So we're making about 18% per month. And that's saying that the SPY doesn't go up very much at all. We lose money on the longs a little bit, and we're being super safe on the covered calls. $7,200 a month on $38,000. That shows you if you have a $50,000 or $100,000 account, you can run the strategy just on the SPY and achieve financial freedom already. If you have a $50,000 account, you're using $38,000. If you use the full $50,000, you'd be closer to 10 grand a month. If you have a $100,000 account, you're only using 38% of it. So on a $100,000 account, this is very safe. On a $200,000 account, you're only utilizing 18% of your total account value to make 7 to 10 grand a month. And this is a very, very safe and conservative outcome. So let's say that realistically you're selling $2,500 worth of calls per week, which is $10,000 a month, because we're doing the 15 to 18 delta, which is not as safe, but still very safe. You're making $10,000 a month. The SPY goes to 590 or 595 by March, and you break even on your calls and you lose no money. 10,000 times 4 months is 40,000. You turned 38,000 into 78,000, literally double your money in 4 months, because you want to sell or roll your long call 30 days prior to expiration, because 30 days is where theta really starts destroying an option. If you get out 30 to 45 days before expiration, you won't lose as much on theta. In the very safe scenario, you make about 29 grand, which is almost double your money, not quite. It's 18% per month. If you go a little more aggressive on the covered call, still very safe at 18 del, you're just not going super ridiculous safe. You're going fairly safe. And the normal thing happens with the S&P. It just goes up normally, conservatively to 585, where it's already been in 4 months from now, which is very likely. In fact, it's very likely it'll go beyond that. You'll lose no money on your contracts. You'll make $40,000. You'll double your money, which is 25% per month. So super safe, 15% to 18% per month. Very safe and very likely 20 to 25% per month. This is a very good strategy. So I know there are going to be those few people that ask this question, Corey, what do we do if the SPY pulls back for a month or two? Well, if this happens, then you'll just wait for the pullback to happen and start selling short calls above where the ETF is unlikely to go. If SPY pulls back to 550, start selling 560s. You can still do that with a 560 leap option because you're right at the strike, so you won't have to put up any collateral, and you'll just sell 560s for a couple of weeks. As the ETF comes up to 560 again, then you go up to 565 585 or 570, and that's how you'd recover. Just keep selling covered calls. Now remember, as your short call increases in value, putting you in the red, meaning you sell a short call for 50 bucks and the stock or the ETF goes up and skyrockets, now your short position is going to be in the negative. So one thing I want to tell you guys, if the SPY goes to 585 and you have a 580 short call, it's going to be worth $500 at expiration in the negative. It's going to be worth more than that during the day because there's time value, extrinsic value, but the intrinsic in the money value, a short call at 580, the SPY's at 585, you're in the negative $500, right? You got, let's say $50 for it. You're losing $450. Don't be scared with that scenario. You can buy that back at a loss and then sell your leap option and then start over, or just buy it back and start selling, or you can roll it out. Remember, leap options and short calls move in tandem. As your short position goes more in the red, your leap goes more in the green. So you theoretically would lose $450 on that short call, but your leap would go up $4 or $450. So if you buy one at a loss to close your short position and sell one at a gain, your long position, you'd break even. They move in tandem. So what I typically do in this situation is I will just roll it out. A loss that big on the SPY, you'd have to roll out a week. So you'd end up losing several $100s having to do that. It happens from time to time, but overall, this strategy, which is why I like to utilize the very safe strategy, because the $29,000 outcome is realistically what will happen when you account for some losses, some weird things happening, maybe the ETF not going up. Realistically, $38,000 makes about $29,000 to $30,000 on average over 6 months. So in a year, $38,000 is going to return you about $50K, maybe $60K. So realistically, 70 to 100% per year, depending on what goes on with the ETF. It's a very good strategy to run in your portfolio. Another thing I want to show you guys, which I would utilize 5% of my portfolio. So if you have a $50,000 account or a $100,000 account, you can run the $38,000 on the SPY. More specifically, if you have a $100,000 account, anything less than that, it's up to you. You can now run $5,000 more worth of this strategy. What you will do is you will do daily, 0 DTEs, as long as you have more than $25,000 in your account, or weekly on the SPY, you'll do spreads. So what we're going to do is we are going to go out to, let's say, one day right here, which is today, on the SPY. If we think it's not going to go above 577, which you can see is where I'm selling covered calls on the SPY, we can get about $30 to $50 a day. I say 576 is very safe as well. So let's go ahead and sell that call. And then we're going to buy the 586. You may not have to do $1,000 spread. You can just get away with doing a $500 spread because it's 0 DTE. If you go weekly, do 1,000. So we're putting up $500 collateral, $459 in this instance because we're collecting 41. And if SPY stays below 576, we keep $41. We don't need to buy a leap option. We don't need to buy shares, and we don't need to do a cash secured put. None of that. So what we're going to do is we're going to continue. We'll get $41 for it. It's $500 collateral. So if we do 10, that'll be $2,500. We could do 20 of these and it'd be about 10,000. Actually, we'll do 10 of these. There we go. $4,500 to do 10 of these contracts. 10 times 500, 5,000, 4,590 because of what we have collected. So if we're going to run $38,000 in the leap strategy, we can also put a daily 5,000 or weekly 5,000 into this strategy. If the SPY happens to go to 578, 579 on one day, then we could potentially lose $1,000. But like I said, this is very risky. So you want to go safer, which is why I chose 576. That is $7 out of the money in one day, almost $7, like $6 and change. We could do this safer by doing a 577 daily and then buying the 582. We still collect $290 on 5,000. This is a lot safer. The SPY has to move $7 in a day, which is highly unlikely. If we look at the delta, 90% chance of success, delta of 10. So if we do this trade 10 times, we'll lose it once. So 9 times, we are going to make 2,700, which means as long as we lose less than 2,700 on our 10th trade, we don't lose any money. And once I see this price going up around 578, I'll just get out at a $1,000 loss. So if we do this right, we make 1,700 out of 10 trades, which averages out to be about $180 $180 a trade, $170 a trade. So that's $170 a day. So you figure 5 days times 170, even accounting for that loss, we're making $850 a week. We're still bringing in $3,400 a month on $4,500. So double your money every month. Now, realistically, if you're going to be running that strategy, you want to go to a 10 or a 15 delta stock or the ETF getting close to 3 o'clock or anywhere near your strike price, pretty much anywhere during the day. You want to start figuring out if it's likely to break or go above. If you can get out at a 10% loss and it looks like it's going to get worse, just get out the next day, do your due diligence to set up the spread again. This is why I won't do anything more than 2,000 in spreads on a $50,000 account, which will give you 4 contracts, or 5,000 on a $100,000 account, which will give you 10. So if you have $50K account, do 5 contracts. If you have a $100K account, do 10 contracts. So on a $100,000 account, you realistically can bring in $290 a day, plus you're going to be making roughly $500 on the covered calls. So if we bring out the calculator yet again, you will be making $290 a day plus $500 on the covered calls. $790 times 5 times 4. In a perfect world, it's $15,000, $16,000 a month. So if we're equating for losses and things that could go on, and let's say your leap options break even, then we'll just go with a 10% buffer ratio. That puts us down to about 14K. So 14,000, and that's a really good buffer. 10K for losses, really good buffer. If you're really good at trading, following my guidelines, 14K times 4 months, realistically 38,000 plus your daily $4,500 collateral. Really, it's 42K. 42K turns into 56K. So you're pretty much doubling your money every 6 months. This continues this pattern, but this is how you can retire and generate passive income. If anyone says you can't retire on 100K, that's not true. 50K, you could consistently bring in about 7K a month. On 100K, you can consistently bring in about 10K to 14K a month. Even if we're going extremely safe, 50K is 5K a month, 100K is 10K a month. This is how you retire early in safe, passive, consistent income. One very important tip to help you guys out on an ETF or a stock when you're looking to sell covered calls. Let's say you're trying to get into selling covered calls on Monday morning. You are trying to open at 9:30. You'll see the stock or the ETF come up, and right at opening bell, it's got a high 584 and it starts to come down. Once you see this stock starting to come down, you're going to want to go above that price. So for instance, this particular day, the SPY was at 584.79 at opening bell and started to work its way down. Before opening bell, it actually was at 584.52, came up a bit and then continued to sell down. Once you see this peak right here, and then the stock starts to come down and turn red, you immediately sell a covered call above that. So 584, we would go to 587 daily. This is $3 above that high. It sinks, and by the time it gets here at 11 a.m. at 580, this call you sold is 50, 60% already profits. You can see the stock comes up, down, up, but it never broke that high. Not broken that high since. The closest it came was right here a week later. So that's what you want to do. And you can also use Bollinger Bands. And when you turn the Bollinger Bands on, you'll see the top of the 4-hour chart is what you're going to want to use when you're daily trading. And you can use the hour chart, but I like the daily. And you can see the daily shows a top of 586. And what did I tell you? I told you that I would go above that in the previous, and I would sell 586, 587, which is exactly what I would do. So the top of the Bollinger Band on the 4-hour, and the 1 hour is also good, but it's going to be relatively the same, 585. So you're in between 585, 586, which is exactly what I said. You're going to go about $1 or $2 above the previous high because we already saw it resist here and started to work its way down. As it starts to come down and the green candle turns red, that's where you go up and you sell, because when you do that, this stock starts to come down, 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 and then this is now almost completely profitable. You can close it out for 60 to 80% profits. And that's what you really want to be doing every single day. Sometimes it doesn't work out like that, but that's how you time the stock and what's going on. If the stock is at a bottom like it is here, you don't really want to sell covered calls at the bottom here. And this is actually on a Wednesday at 1 p.m. So you would have already sold these covered calls earlier. So we'd wait, that would expire worthless. The following morning, Thursday morning, we would see that the ETF is coming up It's already coming up right here. It opens and it's starting to drop. So you would catch this as it's dropping. You'd go above this and sell a covered call for about 583 right here in the Bollinger Band. 583, the top of the Bollinger Band. And you can see that on Thursday, it closed at 579. You'd have been good. Stock market opens Friday morning. You see the stock price coming up. Opening bell, it's going all the way up. You don't want to sell your covered call just yet. You're going to wait till around 10 a.m., 10:30 as this green candle doji's down and closes. This candle opens at 11, starts resisting, coming down red, go up above the Bollinger Band here, 585, and look what happens. Stock drops. So this is how you sell the covered calls. Rewatch this a few times if you must, but this is the ideal way to trade and sell covered calls. If you guys enjoyed the strategies you saw in this video, but you're looking for more guidance and more coaching, and you want a full training course and be a part of the Discord, you guys can sign up at any time. InvestWithCorey.com. Link is in the information box below. I look forward to helping you further on your journey. That's it for this video. I'll catch you guys on the next one. One love. Take care of yourselves, fam.